Hello everyone and welcome to the newsletter for September 6th. Today we're going to be looking at the Yearn protocol, or the YFI token, which has really taken everybody by storm when this thing's basically marched its way from $0 all the way up to over 30,000, almost hit $40,000 in the span of just over a month, which is quite remarkable. And what is very interesting about this particular token and this particular project is it's the first time that I've actually done a deep dive on this technology and been actually compelled to dive deeper and understand more about the protocol. What is very, very interesting about Yearn, or short for Yearn, is it's actually a very compelling product. And if we take the position that DeFi is a genuine feature or a part of our future, that we're going to see these decentralized financial applications, which I do believe is the case, then it's most likely that we're going to see a select few of these things that actually result in significant value capture at the expense of the others. I still believe, and we'll talk about the whole thesis behind this particular project, what it's doing, why I actually do find it quite compelling, and how I think that it actually captures a lot of the narratives that I have particularly been talking about, return to quality and there'll only be one and all this kind of stuff. There's consolidation to a select few core protocols. The reason I find Yearn so compelling is it actually is one of those protocols that if we assume DeFi is going to survive, this to me is one of the most compelling use cases or most compelling projects, because it is similar to Bitcoin and Decred and these other projects that I've obviously got a strong bias towards. This thing is primed to survive, and it's because it is actually larger than all of these other projects. And we'll talk about this mechanism shortly. And really what this graphic is kind of showing, this is something that I stole from David Hoffman, who posted on Twitter, who's the co-host, the Ethereum side of POV Crypto. And he is also exceptionally bullish on this project, and to be honest, I understand why. I think rightfully so. And you can see here that it's basically pulling in. It is the centerpiece that's pulling in all of the value from these other projects. That's really what this meme is trying to point out. And what's very, very intriguing about this is Yearn itself. I wasn't around for it, but I know that the Ethereum project, what ended up forking into Ethereum Classic, was because of the funds that got locked into the Ethereum DAO, which was this first ICO type project that ended up basically taking a whole lot of money in, and then hackers basically found an error in the code and drew that money out. But if you ignore all of what happened during the original DAO, because let's face it, the technology was definitely not ready for it back then, Yearn actually kind of is where that DAO was trying to go. It is that community-driven project that's supposed to be it's basically a community venture fund. And what I find very interesting about Yearn is it is actually becoming, or it has become almost entirely organically and naturally, has become what that DAO was supposed to be. And I find that a really interesting story. But let's get into it and start looking at some of the details. So I mentioned before about narratives, and I think what I like about this is it's a consolidation of narratives. And my thesis has always been that blockchains are good for money, because the only reason you need a blockchain is when it needs to be very hard to stop, right? It needs to be censorship resistant. And really, money is the most disruptive thing in this whole mix, and is the reason that these blockchains are good, right? There is the distribution side, and there's the convenience of global access and all that kind of stuff. But all of that is a subset to blockchains being good at being money. I've always talked about a consolidation to quality, my belief that there's going to be fewer protocols of higher quality than a multi-polychain world where there's 10,000 tokens and they all do a different app. I really think there's going to be a consolidation to quality, so that's part of it here. I've always been of the belief that friction is going to get forked out, and in many instances, tokens are in fact friction. In many instances, governance is in fact friction. There's all sorts of types of friction, and eventually I believe that in an open source world, it will eventually get forked out to be the most efficient, simplistic, and high value. The shipping container analogy. We're going to be forking out all of the little boats and the middlemen, and eventually it's just going to be high value transfers and then scaling solutions built on top. And scalability is a universal problem. It doesn't matter what blockchain you build. If you have a hyper scalable blockchain, then it's highly likely that you have centralized points. If you have an extremely slow and high redundancy, high security ledger like Bitcoin, that means that you've got a scalability problem no matter which way you go. And there's trade-offs. It's all a spectrum, but in order to achieve scalability, you usually have to trade off some form of censorship resistance. And that's okay for higher layers, but at the base layer, there's always going to be a constraint on that. So that's often why I've had issues with Ethereum, is I don't believe that it's dealt at the base layer with scalability very well. It's a very inefficiently designed blockchain. Nevertheless, it's clearly got the network effects, and it remains to be seen what the future of the project actually looks like. But ultimately, scalability is a universal problem, and there's no way that we're going to get around that anytime soon. So I think any project that's pitching you 1 million transactions per second, EOS pitched 1 million transactions per second. When you actually put it under stress test, it was getting something like 100. So the reality is that scalability is a really, really hard problem to solve, and ultimately it's going to go up to higher layers. And keep these in mind: money, quality, friction getting forked out, and scalability. And these all feed into why I actually find Yearn very compelling. So DeFi is a little bit of a spectrum when it comes to the tokens that exist. And I've this is the way that I've been thinking about things. So from left to right is basically saying what I think is the long-term viability, where we're going to get maximum value capture, is actually going to be towards the right-hand side of this chart. And I haven't spent a great deal of time positioning these things other than their general, these specific tokens, rather other than just a general positioning. But the idea is more or less there, and I'll talk them through. So on the left-hand side, things that I really think are just fleeting. We're talking about weeks to months. They really don't have a great deal of longevity, in my opinion. What I'm calling casino coins, things that are designed, basically these yield farming vegetable tokens and rebasing tokens like Ampleforth. And I just don't think there's any real product market fit for those. I think they're get in, get out. I wouldn't be holding them for any long period of time because I really just think they're casino games. I don't think there's any actual long-term value capture there. You've then got things like singular DApp tokens. So in particular, things like 0x and KNC and Loopring and even Compound, and to an extent Maker. Although I actually would put Maker in a slightly special category here, but I'll come back to that. These are protocol tokens that look after one particular thing. Let's take Kyber Network, for example. If no one's trading on Kyber, then KNC accrues no value, right? It's a singular, it's either binary. People are either trading on KNC or they're not. And if KNC is more expensive than 0x, then KNC will lose to 0x. If 0x is more expensive than Uniswap, then 0x will lose to Uniswap. And ultimately, this is the friction problem. Because these tokens are extracting rent, a free open source token like Uniswap, for example, will show up and just eat their lunch, right? It's very hard for them to remain competitive and accrue value to the token, because to accrue value to the token, you need to extract rent from somewhere. And when you're extracting rent from somewhere, the guy who's not extracting rent is going to be more competitive than you. So I think a lot of the DEX tokens I really would lump in this basket, and I really don't think there's long-term value capture here. In a special way, I think Compound is the same here, because yes, it's a large money market, but it doesn't have to be a large money market in perpetuity. Something else can be launched and it can remove the token and could very well be more competitive. Now, as you move to the right-hand side, we're starting to get into what I'm calling the value aggregation type tokens. Now, these are protocols that utilize the services of other protocols, or and really that's what Yearn is at the far right-hand side. It's basically aggregating the value of all of the things below it. And the tokens that are closer to Yearn there, the curves, the Aves, the synthetics, balancer, a little bit of Nexus, I think these are infrastructure plays that are useful primitives. So I think maybe value aggregation and primitives is probably a better terminology here. Things that are core building blocks that enable higher things up the stack. So for example, without Curve and without Aave and without Maker, Yearn wouldn't function. It needs those protocols to exist in order to be the value aggregator that it is, and therefore that value can flow upstream. There is going to be no value flowing from Aave down to Kyber Network, or very little, right? Unless it's using that particular swap, and eventually it's better for Aave to actually build its own DEX and just fork Kyber if that's useful, and implement its own DEX swap system. So you can see here that value will not flow from the right-hand side to the left-hand side, but value will flow from the left-hand side to the right-hand side. If you've got casino coins, they can trade on the DEX and they will make money for KNC, right? They will also trade and become liquidity and earn liquidity pool fees, which will again extract rent for the RVs and the balances and the curves. And then ultimately Yearn is up at the very top there, which can capture value through that entire process. So it's a very interesting type model that we're seeing here, but there's no value from curve flowing down to vegetable tokens. The vegetable token are the cannon fodder that just floats around and creates a trading item. Same reason that CZ at Binance will list any token that he wants, because he does not care what the value of it is. If people are trading it, right, he doesn't care whether it's going up or down. He's making money on the trading fees. He's just a platform to host these things. He's making money either way. And if the coin finally loses all volume, that it's not worth keeping the exchange pair up, then he just gets rid of it, right? Problem solved. You made your money, you walk away. So the middleman here is actually who's collecting the fees. And what we're looking for is this long-term viability and value capture goes right to left to right, not the other way around. So the Yearn solution. Yearn Finance is one of the most compelling tokens in my view at this point in time. And granted, I haven't done a significant deep dive in a great number of DeFi protocols because I just don't find them compelling, which is actually why this is somewhat special in my eyes. And really, the elevator pitch is it's basically Berkshire Hathaway on chain. And ultimately, what it's trying to do is be that it is a governance-heavy protocol where it deploys strategies to earn yield for its liquidity pool providers. So you deposit funds into Yearn. It is basically designed as an optimization strategy to go and find the best yield depending on what strategy you end up putting your money into. So I guess one way to think about it is it's like a set protocol, except without being a single fixed by this set index token strategy. This thing here is a lot more mobile. So it is more of a governance heavy, rather than produce a set token, which is a single object or a single token that follows a predefined strategy. The Yearn protocol will basically follow a whole number of different strategies depending on where the governance takes it. So that's kind of why I'm pitching it as the Berkshire Hathaway here in this particular instance. And the memetics of it having 30,000 units only is really what's driven it to have such a high price. Which is not dissimilar to Berkshire, which trades for $300,000 a share because they've never ever done a stock split. And I think this is actually this is a memetic thing, just the same way as it is for Bitcoin, that there is only 30,000 Yearn units, and my understanding is that there is very little probability that there will be more, because initially there was a governance vote as to whether they should mint more to try and bring more people in. And the reality is that the token accrued so much value and the community grew so significantly, and actually we've seen a large number of people leaving other protocols like Maker. I can't remember the other ones, but there's about 3 or 4 different high-profile DeFi developers who have all left their roles at various other high-quality DeFi projects and moved into the Yearn system. So it's actually becoming a bit of a sink for the brains in the space. And again, follow the smart people. This is another piece of evidence saying that there is a lot of brain power going into this protocol, and that is something to be keeping an eye on. Follow the smart money. And really what it's becoming is what the 2016 Ethereum DAO wanted to be. It's a self-funding, ecosystem milking, hyper-efficient hedge fund cross-money robot. And ultimately it's stitching all of these protocols and the yields and all that kind of stuff together into a single product. And the idea is that you can, whether you're a user or you're a YFI holder, you are capturing value from all of these different strategies as delivered by some of the smartest minds in the space. So let's just go through some of the I guess core components of the YFI token and the protocol itself. So Yearn is essentially a suite of DeFi products, and Andre Cronje, who I believe is a South African dude, he's the core brains behind it. He's actually been building this Yearn tech for some time. And they built a lot of their products prior to the YFI token being released. And really, the YFI token was an answer to needing some kind of brains trust to actually manage the strategies in play and take advantage. And really, it was the advent of liquidity farming, where you've got these other tokens that are issuing their rewards, and you kind of need human discretion to capture those best opportunities on how you actually sell those LP tokens, right? You're earning some kind of governance token, and then you can sell them onto the market. There is some kind of connection there. You need a human layer to overlay that. It's not something you can automate. Previously, Yearn was automating, so you would be looking at the interest rate at Compound, the interest rate at Aave, the interest rate at all these different money markets, and it would basically just every time someone deposited funds or withdrew funds, that's a transaction, it would go and consult all of the different price feeds or yield feeds, and it would then switch, right? So every time someone interacted with the contract, it would go and find and move the whole pool to the next most optimum place, which is a gas efficient way for people to earn the best yield at any one point in time. So it started as just that, but once you add this human layer, it needed a Wi-Fi token to actually provide some kind of governance control over it. Now, people pitch this as one of the few, if not only, fair launches in DeFi, because they basically released this Wi-Fi token as a liquidity farming or mining. I think it was about a week or so long distribution period, so it was very quick. They pitch it as saying it has zero financial value, no pre-mine, no sale, you can't buy it, not on Uniswap, no auction, and they don't have any of it. So the idea is it was just whoever's using the Yearn protocol, bang, you start earning the Wi-Fi tokens, and then that's the end of it. So you provide liquidity, you end up getting these coins, and the thing started at $35, and then has basically pumped up to 40,000, is now down about 22,000 at the time of recording. So, it's one of these fairest launches since Bitcoin into a well-developed market. Yes, of course, there's going to be whales who accumulate a large portion of it. And I believe I saw a table recently that showed that the average of the top, I think, 100 holders is about 100K. So 3 or something tokens. I think Andre himself has about 2 of them. So, by and large, it's fairly well distributed on that front. And it certainly has a better distribution, albeit it's still a small number of holders, a better distribution than the majority of tokens in this market. So, as far as launches go, it's about as fair as it's going to get. And we've seen a whole lot of clones shoot off the back of this, and none of them have gained anywhere near the same kind of traction. And it's the community and the people coming on board as a result of this that is extremely compelling and something to be very conscious of. So a very quick overview of the product. Now, I'll be fair, I've only really looked into the vaults and the earned function of this. I've not spent a great deal of time looking at the other ones because I haven't wanted to put any money into them as yet. But my understanding is that from the left-hand side, we've got the vaults, which is basically the governed strategies. This is the hedge fund portion and is the highest risk element of a lot of this. So I haven't looked at the collateral vaults, leverage borrowing, and borrowing down the bottom there. Obviously, there's going to be risk involved with all forms of leverage. I suspect that it's more of an automated zap process rather than, me, myself, go and get DAI out of Maker, send that DAI somewhere else. Like it's an automated leverage borrowing using Aave and all that kind of stuff. So the left-hand side is the highest risk. It does have a lot of smart contract risk. There's, higher yields possible, but it is a higher risk hedge fund type system. The earn function is more of a optimized liquidity pool. So go and find the best place for my stablecoin. It's predominantly for stablecoins. You deposit your DAI, your USD, USDT, whatever it is, and it will go and find you the most optimized rate. Every time someone transacts with it, the vault will move to the best yield at that point in time. So you get an overall smoothed highest APR. There's optimized trades using the Zap feature, which basically will go and again find the best trade rate for whatever your coin you want to swap is. There's comparison tables for the different yields, and you can see that Yearn will be getting 5, 6, 7%, whereas everything else will be getting 3, 3.5, 4, 2. So it is more competitive. And they recently released a bunch of insurance primitives that basically give you cover for a set number of days. More or less, you're buying options. Is the general gist of this. So really, Yearn at the end of the day is a one-stop shop. It's gas efficient. It's yield optimized, and what's really important is that it's scalable. So by a single person investing in, by everybody investing into the Yearn system, you basically set and forget. So rather than having a whole stack of transactions as everybody's individually trying to move between different farms and different liquidity pools and so on and so forth, basically the the entire pool moves as one go. So it's more gas efficient because it's moving the whole set of people who are involved in that vault at the same time. And it does it every time somebody interacts, and every time someone deposits or withdraws from the contract, it reevaluates its current position and it moves the funds to wherever it needs to go. So in that sense, it's actually a scaling technology. You can kind of think about it as a Lightning Network, where a bunch of people deposit funds into Lightning Network. You do your million transactions, sending funds around the world, blah, blah, blah. And then eventually you do a single withdrawal, and it's a single on-chain transaction that represents a very large number of people's settlement, right? It's the settlement layer. And this is actually why it's a scaling technology, as well as a yield farming, gas efficient, one-stop shop for this kind of thing. So if you look at the traditional yield farmer on the left-hand side, making a whole lot of transactions, spending an absolute fortune on gas, worried about stress about where they're going to move to next. They've got all sorts of crypto diversification, 1,000 veggie tokens. They buy into these staking coins like KNC, SNX, 0x, but they can't afford to stake because the gas fee costs you $30 to get your stake of 6 cents. And they're chasing these 10,000 yield pumps, and ultimately they lose because they're just inefficient, right? Unless you and I have huge sums of money, hundreds of thousands of dollars like VCs to deploy into these schemes, it's very unlikely that you're going to make money from this yield farming because it's just going to burn you on the gas. It's just not competitive. And the converse is that if you're just depositing into a single money robot, and even the SET protocol is something that's kind of similar to this. SET protocol is the precursor to Yearn. Yearn is kind of the next level, the most advanced version of what SET was trying to do. And to be honest, this is almost completely blown SET out of the water. I think that it's, unless you're going for a very fixed strategy, I think Yearn is going to decimate SET on in the long run. And you basically do a single deposit. You could, spends extra gas on buying Wi-Fi to capture more of the value. Sleeps on beds of money and takes degen's money with ease, right? That's really what this system is doing, is you're putting it into a money robot rather than trying to chase these yields on your own. But again, there's risks, which we'll get to the end and talk through those. Now, one really cool feature is that the Yearn governance system has basically introduced a treasury. So all of the fees and the income, the revenue that's generated by the Yearn protocol goes into the treasury. And what they've set up is that once it gets to $500,000, there is no money none of the revenue goes to Wi-Fi stakers until the treasury hits $500,000. And this $500,000 is used for ecosystem development, for paying out and building up the protocol. It's basically the sustainability side of things. And you can see here that it actually hit that $500,000 mark in 10 days, which is insane. And it really shows how quickly the value will capture. Now, again, there's going to be a process of consolidation. Initially, it'll spike up during the DeFi boom. I think we're going through a bit of a correction now, so it could be some time until there's more momentum. But ultimately, this is the type of project that will be building in the bear market and profiting in the bull market, which is really what I think the trade is here. And anything above the 500,000 gets slowly deposited to Wi-Fi stakers' accounts. So if you're staking your Wi-Fi, you're essentially earning the cream that comes off the top of that $500,000 minimum in the treasury. And the way that the treasury builds funds is by two mechanisms. Whenever somebody deposits into a vault or a strategy, there's a 0.5% withdrawal fee. So if you deposit and then withdraw your funds, 0.5% of that will be allocated to the treasury. And I believe that the treasury accumulates, you can see there, the number one equity element is Y Curve Vault, which is essentially a interest-bearing token that is a basket of DAI, USDC, True USD, and Tether. So it's basically a weighted basket of those. I think majority of it is DAI, 30-something% is DAI, 38% or something like that. And it more or less accumulates like a basket of stablecoins. So it's USD denominated with interest bearing. And it will also take a 5% performance fee. So every time, there's a little bit of confusion. To be honest, I'm not entirely sure I understand it myself. I don't believe it's 5% on profit. I believe it's 5% because it's subsidizing gas more or less. Where it's pooling the gas fee across everybody who's involved. I believe that every time there's a transaction, 5% of the transfer value or the gas fee And because if people are withdrawing and depositing on a regular basis, basically every time the protocol is moving the coins around, it's taking 5% of that transfer fee. So every time somebody interacts with it, 5% of the gas cost goes into the treasury, and the rest gets allocated to obviously moving the fund around. I think that's the mechanism. I could be wrong there, but more or less, I think there's actually a vote or a discussion going on at the moment to be 5% of profit, because you would initially think that that's what makes sense, right? It's a profit system. And I think that the community recognizes that most people believe that when they deposit, it's a 5% management fee, which, to be honest, is coincident with most hedge funds and other money managers. It's not an unreasonable sum. And because most people think that that's what they're signing up for, it actually makes sense to just make that the system. So I actually think this treasury is going to grow substantially faster and higher, which again is a value add considering how quickly it made it to 500,000. I think if DeFi becomes a real thing and we get some momentum to the upside here in this bull run, then there's going to be quite a bit of money accruing into this treasury, which again is a bull case for the YFI token. So let's go over the vaults, because I think these are the most interesting. I mean, for the Yearn systems, it's more or less you're providing via a single interface a liquidity pool. But let's go top to bottom here. There's 3 different tiers. So there's the earn pools. So this is where you have a stable coin, let's just say DAI. You deposit DAI into Yearn earn pools. You now receive what's called a Y curve token. Now that is essentially a Yearn Curve liquidity pool token. So you have deposited DAI into Curve via Yearn Finance, and you are now receiving interest. It's an interest-bearing token. So you've taken your DAI, you've turned it into an interest-bearing DAI. Now it's not actually DAI. That DAI gets exchanged into a basket of DAI, Tether, USDC, and True USD to maintain that resiliency in the peg, more or less. So you deposit a stable coin of some form, it will turn it into a basket index of stable coins and earn interest. So that's what Vault 1 is, right? That's tier 1. Tier 2 is then the vaults. So that's the earn protocol tier 1. The vaults then takes that LP, that liquidity pool token, the Y curve, and it deposits that back in to the Curve finance system. And what this is now doing is it's now generating, so initially it was just interest bearing. Tier 2 then turns it from interest bearing into interest bearing plus earning some kind of liquidity pool rewards. So in this instance, if you're getting some kind of liquidity mining that's going on, and there's, in Curve's instance, they're issuing the Curve token, this strategy is now earning not only the interest, but also earning the trading fees and the liquidity mined Curve, which it can then sell, acquire more stable coins. So this is essentially taking stablecoin in, restaking the liquidity pool token to get the fee generated and the liquidity pool, which gets sold into more stablecoin, rinse, repeat. So this is how you get an advanced APY. Again, there's more smart contract risk as we go down this list. Now, tier 3 is the very bottom one. Now, this is the product that was recently released to much demand. I think it now currently holds something like 300 and something thousand ETH, which is like 0.3% of the supply, which in 3 days or 2 days, I think it was. So it's quite significant. Now, what this does is it will take ETH, it will deposit it into MakerDAO. It will then withdraw DAI at a collateral ratio of 200%, and we'll talk through this mechanism shortly. You now have DAI. It will now take that DAI, put it into tier 1, generate an interest-bearing token. Take that interest-bearing token, deposit it into tier 2, and generate the liquidity mining fees. Now, instead of selling the Curve into dollars or a stable coin, it sells it into ETH, and then it deposits that ETH into the Maker Vault, and then you get a rinse repeat. So it's these. You can see how it's building up from an interest-bearing token to an interest-bearing token with yield to depositing collateral, which then withdraws a stable coin, which then creates interest, which then creates fees. It's this tiered approach. That's really what is going on here. So obviously you can see there's a lot of steps involved. And ultimately, this is where the scalability comes in. Can you imagine doing all this yourself? You would burn yourself through the floor with gas. But if you're doing this with a huge pool of people, basically the whole thing becomes extremely scalable, extremely cost efficient. So that's really what's going on. Now, this is this is actually the thing that I think is the single most compelling element of Yearn. And I'm already participating in one of the YETH vaults because I think it's something that I haven't done any liquidity farming except for this. And this is the first thing that was compelling enough for me to give it a go. So this is what I was talking about before, and there's 2 slides where we'll talk about this. You start with Ethereum and you deposit that into the Y ETH vault. What it does initially is it combines ETH with MKR being the bank, so it takes the collateral, it deposits it into the bank, it then withdraws the stablecoin DAI. Now, for those of you who've been following Maker for some time, you know that their stability fee has basically been 0 since about the start of the year. They have been unable to maintain a DAI peg. It's always traded as a premium because there's such a demand for it in the DeFi space. It has been unable to come down from like 1.2 cents and hit that $1 peg. Now, the way that Maker tries to generate fees is via the interest rate. But if DAI is above the $1 peg, then it cannot impose a stability fee because it needs to reduce it to 0 in order to incentivize people to borrow and create more DAI, right? You need to get more supply onto the market to bring the peg down, increase the supply to bring the peg closer to $1. And they've been unable to achieve that the entire year, even with interest rates at 0. So what this is doing is en masse. And I think that the Yearn vault is now the largest CDP. So within 2 days, it eclipsed all whales in the Maker system and is now the largest vault in the game. So it's generated $70 million worth of DAI. And now, because it's actually bringing the peg back down in line with 0, MKR can now increase the stability fee. So what's going on here is that because there's now so much DAI in circulation, driven by this Yearn vault, and I think Maker even increased the DAI vault, the DAI supply ceiling to accommodate it. You've now got this symbiosis where the Yearn vault is earning APY rewards. It can afford to pay a stability fee because it's making so much yield elsewhere, and therefore it can actually recover all those costs for the DAI and actually create enough of a supply that Maker can start earning money as well. So the Yearn vaults are actually beneficial for Maker. It allows Maker to start generating revenue again. And this is really, really compelling because it's actually a symbiosis relationship rather than any kind of, it's not a leech. It's actually helping the system as a whole. And to be honest, this actually is very bullish for MKR in the long run. And it's especially important for DAI because I think DAI is actually an important piece of infrastructure. So these 3 kind of form. Let's go to the next slide along. Those 3 tokens, the Ethereum, MKR, and DAI, create the collateral vault. Now, what's happening is you're depositing that into the Wi-Fi money robot. It's then putting those DAI into the Curve system, the Curve LP pools. That's now generating fees from people trading. It's generating yield from deploying those strategies into different API and moving it around. It's creating those basket of stable coins, which is then returning those fees and yield to the Yearn protocol. So that's benefiting the Wi-Fi holders. It's also benefiting the people who are in the vault because that those rewards are basically getting paid out in stable coins that are being swapped to ETH. And the curve that is being liquidity mined in that whole system is also sold into ETH, and that ETH is then redeposited back into the collateral vault to generate more DAI, and this thing starts to cycle around. So what you can actually see here is, I mean, ultimately Curve is kind of the on the losing end of all of this, and that its Curve tokens are being mass dumped. Now that said, even though the Curve tokens are being sold, I think that Wi-Fi only represents like 10% of the sell pressure on Curve. I saw a chart the other day because people are whinging that Wi-Fi is depressing the price of Curve. Curve has a huge amount of supply still to be issued. It's like, I think it's issued like 2% of its supply. And it's got 98% still to be issued over the next, I think it's 4 years. I could be wrong. So I think that the Yearn protocol only represents like 10% of the actual sell pressure. So really, I think that people are just upset that their token has a very large issuance problem for the foreseeable future. But we'll talk about that as a risk shortly. But in short, this is the system. So ultimately, we get a stable DAI peg. Maker starts generating fees. People who are depositing into the YETH vault, and deposits are actually closed down at the moment because there was so much demand for it. And I think they just wanted to see how the system overall, the whole ecosystem balances itself. But you've now got Maker who can generate value. You've got Wi-Fi that's earning money from all this trading fees. So Wi-Fi holders win. Ethereum vault holders win. And ultimately, it's basically a money robot that's just extracting maximum value and providing a very strong APY return for people with Ethereum collateral. And what's really great about this system is that the Yearn protocol is actually hooked into the Maker Oracle system, Maker security module. So what that means is that every hour, the Maker price oracle, what the liquidation price is, updates. Now, Yearn is hooked directly into, and it can actually see what the next one is going to be in the next hour. So it can actually see into the future. So that means that the Yearn protocol, en masse, with the whole 70 million worth of DAI debt, can actually deleverage itself with knowledge that is faster, more efficient, and ahead of the curve of all the other traders in the room. So in that sense, it's actually able to deleverage itself before anyone else. So in many instances, this is actually the best way to maintain a Maker vault, is actually just to use the Yearn vault. Now, granted, we'll talk about the risks shortly because there's no shortage of them. You can see that there's a lot of complexity in all of this. But from my perspective, once we get a bit of Lindy effect on this type of thing, to me, this makes a whole lot more sense. An automated system, an automated money robot that utilizes Maker, which is very, very, Maker has good Lindy effect, right? Maker's been around for quite some time now, and it has a lot of resiliency in the code. It's one of those high value systems in the Ethereum DeFi system, in DeFi space. So that was actually what was, to me, was kind of the trigger point. I do have a degree of trust for the Maker code that I don't have for the majority of the other protocols. Curve remains one of the big risks vectors in my eyes because I don't fully understand the code base there. But a money robot that's able to manage a 200% collateralized ratio with able to look into the future better than I can with a gas efficient system, to me that makes a lot more sense than managing a CDP on your own. So that's kind of the gist that's going on here. So the advantages of these YETH vaults in particular is that there's gas efficiency. You basically deposit once and then set and forget. It's yield optimized, and it's basically looking for those best risk-adjusted returns, which is positive. It's designed and built by some very, very competent devs, and we're seeing this brain drain from other protocols into Yearn, which means that you're going to get quality code and good code review, which you're not going to get in a large portion of the DeFi ecosystem. It's tax efficient because it's basically a single transaction, and you only recover your funds, at your discretion. So it's a single transaction, and rather than having multiple transactions, multiple trades, and trying to work out what that looks like on your official records, it's basically an in and an out, and you can do your tax system in a much more efficient manner. And it's got the automated deleveraging, which means you're not managing your own risk. It's automatically maintaining a buffer, and the money robot is going to be able to manage this thing much better than you and I are as an individual. So I think that OSM, the Oracle security module integration with Maker, is critically important and a real value proposition here. Now, the key risks. Now, clearly, this is a fairly complicated system. I would say one of the most complicated systems in DeFi. However, that said, it's also taken reasonable approaches to minimize those risks by touching as few things as possible, right? So and I like the fact that it's involved with Maker, because I think Maker is one of those Lindy tested, battle tested, hardened protocols. So ultimately, there's a smart contract risk, and this could be the strategy code breaks. It could be that the vault code breaks. It could be that Curve liquidity pools break, or it could be something that goes wrong with Maker. So there's lots of interaction risk there and smart contract risk, which definitely exists. There's an arbitrage and price risk. So if we see something like a massive Ethereum sell-off, maybe the vault can't deleverage itself in time. I think this is a relatively low risk, but there is always, these markets are complex and there are incentives for people to break them. So there is an arbitrage and price risk. There is a liquidity risk. What happens if it needs to pay back a whole bunch of DAI and there's not enough DAI inside the Curve system? What if it's all been withdrawn and it can't actually get access to enough DAI to deleverage itself? That is a risk. And it's also an attack surface. So someone could, with enough capital, could George Soros the system and try and break the peg. There's a Wi-Fi governance risk. So because it's a governance heavy system, it is possible for there to be a cartel or collaboration between majority holders to actually drain a large portion of these systems. I believe that that is possible. So there is a governance risk there, and obviously the more distributed the YFI token gets, the more beneficial and the more risk averse this is. Yes, there's a skin in the game component, but this is certainly a risk to be aware of. There is a curve governance risk. How do they deal with these strategies if they don't like them, right? And they think that they're just mass selling curve. They're incentivized to try and change the system, right? People are going to be upset by dumping pressure, even if the numbers don't align with it. That doesn't necessarily matter because people have, whatever their views are, they don't necessarily have to be grounded in data and reality. So there is a governance risk there, and also a code risk for curve, which is probably, to me, that's the biggest risk that I see here. And the other thing that a lot of people are not talking about, but I hear a lot in macroeconomic podcast, is the problem of passive investing risk. Mike Green in particular is someone who talks about this quite a lot on Real Vision and things like that. And what this is basically saying is, if you look at the S&P 500, everybody's invested, these hedge funds and these passive index funds, and the rise of passive investing. When it first started buying into these indexes, the idea is that they would be 0.01% of the market. So they would assume, the passive index assumes, that the smartest guys in the room are all pricing things correctly, and they are then following the weighting and the pricing of the market. So they let the market do the pricing, and the passive index then follows that strategy. Now, what they don't account for is their own impact on the market. Now, what happens if these passive indexes become 2, 5, 10, 15% of the market, which is actually where we're at in the traditional markets? If now that these passive indexes, and this is what you see when companies could get listed into these S&P 500 indexes like Tesla, there's a whole lot of hype and people bidding up the price in order to push it into the index, because they know that once it gets into the index, all of the passive investors are forced to buy it. They must buy it to allocate that percentage, which creates more buying pressure. And because they're now 10, 15% of the market, they actually move the market, right? So that buying pressure creates even more buying pressure. And that will work to both directions, right? Buying and selling. So the risk of passive investing is that it's brain dead, right? People aren't thinking about it. And if people know that the YETH Vault is doing a particular action, large players could potentially move the market in a way that is advantageous to them and disadvantageous to the robot. So it remains to be seen how this plays out and how large this thing actually gets. But clearly there is huge demand. Now, if they raise the deposit system so people can keep depositing their ETH in there, I strongly suspect that this thing will grow to single-digit percentage points of the entire ETH supply. And then you have a very large portion of DeFi moving in the same plane. So it's kind of, is everyone in the herd doing the same thing? And then it comes down to, what is the resilience of these strategies? So there's a lot of risks involved here. And these are just some of the ones that I can kind of think of off the top of my head. So, high APY comes with a high risk. However, I believe that this is a less risky system than the vast majority of DeFi veggie token mining, right? So that's kind of my risk model here is, if there is risks in DeFi, it's kind of common across the whole field, right? It's not unique to Yearn. I think Yearn, with the smart minds that are actually behind the project, is actually one of the most risk-averse systems. So this is something to just keep in mind. I actually think it's less risky. All of these are present across all markets, right? In this instance, you've at least got smart people behind the system taking care of a lot of these risks and considering them. So I think that's something to be aware of. So just to kind of summarize, I know it's been a bit of a long one. It is one of, to me, the most compelling DeFi projects. I have essentially liquidated all of my SNX to hold just YFI. It's my only DeFi play at this point in time. And if that gives you some indication of the level of how compelling I think it actually is. I think it's because it's able to capture value from everything below it and capture it in a very strong product market fit manner. People want to use this system, and that is important. And I think it's primed to become a money-making machine, in inverted commas, if DeFi does in fact survive. So I think that's kind of the crux here, is this is what I think the Ethereum DAO wanted to be in 2016. And I think that that's really why we've seen this price move up to $30,000, hit $1 billion market cap. To be honest, if this thing here, I think $1 billion, when you think about a hedge fund on chain able to capture all of this value, and particularly as we move into a bull run as a scaling solution, I think there's a huge amount of money that's going to actually get deposited into this system, and I think that's going to be beneficial for the treasury, and I think it's going to be beneficial for YFI holders and people who are using the product. So again, all those risks above we've talked about, but I think if there's anything that's going to capture value, nothing will capture value faster and harder than this, in my personal opinion. I think it's got the right product market fit. It's so far beyond a single app token, it basically benefits from all apps that exist. So some resources that are worth keeping track of. I found that the naming convention for a lot of the products and application layers and discussion forums and things is not unique. So these are just some of the ones to be aware of. There was a recent Bankless podcast with Mariano Conti from the MakerDAO system, who has recently left Maker and is basically looking to join the Yearn system. He's now one of the multi-sig signers. So that to me, that's a signal of smart people moving ship. Uncommon Core podcast has 2 talks with Andre Cronje, which is definitely worth listening to. Andre has some good Medium posts that are worth reading to understand a little bit more about these products specifically. Yearn.finance is where you actually look at the vaults, the Earn and the Zap products. YGov.finance is where if you have Wi-Fi, that's where you actually stake it. The reason I'm putting these up here is because they're uncommon naming conventions. I don't want anyone, if you are looking at these things, to go to the wrong website and deposit into a scam or a Ponzi or something that's not legit. So if you are looking, just make sure that you're bookmarking these particular websites, because there are going to be copycat scams. Gov.yearn.finance is the governance forum. I highly recommend spending some time before you even look at investing in Wi-Fi, or if you want to do more deep dive research. I strongly advise you spend some time on this governance forum and just read through and see what's going on there. I found it to be very, very the conversation that was going on there it built a lot of confidence for me. So that's I would highly recommend just go through their governance forum, see what people are talking about, see some of the discussions going on. There's a community blog called Yearn.finance, which is worth having a look at. It's very shill heavy, so read it to find links to other information. Consider that it is extremely biased towards the bull case, which is fine, right? Sometimes that's what you want to see. You want to see that bull case. But I would certainly be using it to find more resources, right? Use it as that initial stepping stone to go and find more stuff. And then there's the Feel the Yearn app, which is basically all of the statistics and other views. So that's my overview. There's a lot to unpack here, and there's a lot of risks, and there's a lot of value proposition, to be honest. So as always, if you want to have if you want to talk about any of the details or understand more about it, this is not my fullest, most comprehensive research. This is what I found in about the last week and a half. And to be honest, I'm going to be doing a lot more research to understand more about this protocol and how it's working and how it's functioning. And in particular, understanding more about the risk side of things. Where are the failure points? But if you are interested, just grab me in the chat room. We can talk about any of the details and how this thing all stitches together. And because this is going to be a constant learning journey, but I would certainly recommend these resources to give you a bit of background. Look forward to catching you in the Discord. Cheers.